Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Janus Henderson Investors recently released the findings of its 2022 retirement confidence report, which seeks to better understand how self-directed investors are coping with this year's challenging market environment. Joining me to discuss is Matt Sommer, head of Defined Contribution and Wealth Advisor Services with JHI. Matt, it is great to have you with us. Welcome to Trade Talks.
Thank you very much, Jill. Thank you for having us today.
You got it. And can you tell us a little bit about why and how Janus Henderson Investors decided to conduct a retirement confidence survey?
We conducted an online survey in early October of 2022, primarily to better understand how individual investors were coping with both the volatility in the capital markets as well as rising inflation. What we did is receive responses from approximately 2,000 investors, and our survey was restricted to those individuals who were at least age 50 or older, because we were primarily concerned with pre-retirees as well as retirees, and individuals who were either the primary or the shared decision maker for their household for all things financial.
And clearly investors are concerned about both the markets and inflation, but do you think there's more to the story here?
There is a little bit more to the story. Perhaps not surprisingly, 79% of respondents were somewhat or very concerned about the capital markets. 86% were somewhat or very concerned about inflation. But when you dive a little bit deeper, we found some other items that we think are extraordinarily interesting. First and foremost, one of the things that we found is that while people are on average concerned, their confidence in the ability to have the retirement lifestyle that they envisioned has not entirely collapsed. It's about 50-50, whether they experienced a drop in confidence or they did not experience a drop in confidence. Secondly, we found that while females were more concerned and more likely to have experienced a drop in confidence compared to males, what was really fascinating is that it was males who were more likely to have sold some of their stocks or bonds as a direct result of what was happening within the capital markets. And this really confirms a lot of our understanding about gender differences and some of the behavioral dynamics in thinking about both male and female behavior as it relates to long-term savings.
Yeah, it is so interesting, Matt, when you take a look at behavioral finance and how the different genders work their portfolios, whether trading or investing. I agree with you there. What do you think is the most important takeaway for financial services professionals?
For financial services professionals, the most important takeaway we believe is really twofold. One, on average, people have not sold. So I think there's some really great news there for individual investors as well as financial advisors regarding people have learned that it's really all about time in the market rather than timing the market. The second thing for financial advisors, which we think is critically important, is we asked, what are your preferred investments for generating income, either in retirement or during retirement? And there was a three-way tie between taxable, tax-free, and bonds and annuities in the 20s, but 2/3 of respondents said that they want investments that pay dividends. In fact, the respondents who were most likely to want dividend payers as part of their portfolio in retirement were those with investable assets greater than $2 million. So I think it really speaks to the bird in hand theory, where if I were to buy a stock, three things could happen. It goes up, it goes down, it stays the same. But if I'm at least receiving a dividend while I wait, that's the bird in the hand, and it speaks to investors' preferences for dividend payers.
Now, what about individual investors? What does this mean for them?
One of the things that we found for individual investors is among those who currently don't have a financial advisor, approximately 9% are very interested in hiring a financial advisor. The other thing that we found is among those who currently have a financial advisor, less than 2% are interested or considering making a change. And this really confirms one of the things that we learned back in the Great Recession in 2008. These types of economic issues serve as a catalyst for people who are not currently engaged with financial professionals to go and seek help, But at the same time, what's happening in the markets and what's happening in the world around us is not necessarily being blamed by the investor on their financial advisor. Hence, so few are making changes. So I really think it speaks to the fact that individual investors really value their financial advisor relationships far beyond simple returns. There's so much more that financial advisors do for their clients.
And Matt, finally, what did your survey reveal about investor optimism about the future? So
investors are optimistic about the future. Mind you, this survey was administered back in early October. And at the time, 60% of our respondents felt that 12 months from now, the S&P 500 would be a little bit or a lot higher. And 14% felt that it will probably be roughly the same 1 year from now. So about 3/4 in early to mid-October felt that the worst was over and brighter days are ahead. It was only 1/4 of respondents who actually thought that the S&P 500 would be lower 12 months from now. So on average, investors are very optimistic on their outlook for stocks and bonds moving forward.
All right, Matt, we appreciate these insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.